Hello everyone, welcome to this lecture 2 of this last week for this course Metrics and Analytics of Marketing. In this week we are discussing various metrics which can link the marketing metrics to the financial performance. So we also understood that marketing and finance are closely related to each other. They cannot work in isolation, and that is why the marketing managers needs the knowledge of financial metrics as well. So in this week we have been discussing about various basic financial metrics which can be useful for the marketing managers to justify their actions, to justify their set of activities. And if the marketing managers have a better understanding about the financial metrics, financial performance, then they can convince the finance department regarding their expenditure in a better way. In today's lectures, we will be discussing about two of the most important and critical financial metrics which are called return on investment and economic profit. This return on investment is described in variety of forms, but we will discuss about the simplest type of forms. Okay. So, let us dive more into these two metrics one by one and try to understand how these metrics help the marketing managers take the business decisions. So, the genesis of this matrix return on investment or the economic value added comes from the concept, comes from the idea that profit alone is not enough for investment decisions. If I only look at the profitability and I make an investment decision just by looking at the metrics related to the profits, then in that case I might end up taking a decision which is half purviewed, which is half informed. So that is why if I want to make my decisions, financial decisions more rational, then in that case I have to look into more detailed metric. Profit does not indicate how much capital was required to generate this particular profit, right. So it is just total revenue minus total cost. This is profit. Again on a better metric like return on sales, it is net income divided by total sales. But what is the amount of capital investment done in order to operate or start this business? That questions become unanswered if we look into metrics such as profit or return on sales. So that is why we also need to take into consideration what is the amount of investment done in order to generate this amount of profit. Two firms may earn similar profit but use very different level of investment. I have already given one example, I think in my last class, that one firm generating 1 lakh rupees as profit on an investment of 5 lakh rupees is doing far better as compared to another firm which is generating 2 lakhs rupees of profit on an investment of 1 crore rupees. So that comparison cannot be derived from the profit matrix alone, and that is why we need to calculate some metric which also takes into consideration the amount of invested money, and that is where the important metric return on investment comes into consideration, right. So let us look into this ROI concept. So I think for people who are into the business domain or business studies, ROI, irrespective of your domain of expertise, ROI is a very common term. Everybody understand what is called ROI, return on investment. But again, return of investment can be described in various forms that we will discuss in the subsequent slides. Let us first try to understand the simplistic meaning of return on investment as a metric. Return on investment or ROI is one way of considering profits in relation to the amount of capital invested. Return on investment measures profit relative to the investment needed to generate that amount of profit. So it is not looked, the profit is not looked in isolation. It is always looked as a proportion of amount of investment being done. In a way, it is a snapshot of profitability adjusted for the asset commitment. How much is generated from how much? So, that is being answered from this metric return on investment. As from the concept itself we can understand, we can generate a very simplistic formula for calculating the return on investment. That is net profit in terms of the currency divided by the total investment in terms of the same currency. So, this is the formula for return on investment. Now, let us look at return on investment matrix, what ROI tells the marketers, which was not told in case of profitability matrix or return on sales. So, we know that marketing affects the profits directly. Marketing also affects the inventories, the amount receivables and the capital needs. So, we know that let us say depending on the quantum or extent of marketing activities that is performed efficiently, the demand that is generated for the next financial year or next session is decided. So, that is why it has a direct impact, the marketing initiatives have a direct impact on whether the inventories will be piling up in the warehouses or there can be a possibility of inventory crunch due to surge in demand, or it will be just like balance between quantity demanded and inventory available. So, that is decided by the marketing set of activities, and hence marketing direct impacts the amount of revenue that needs to be received. Marketing directly impacts the receivables from various collaborators in the business, and marketing also directly impacts the capital needs. Capital needs might come in terms of the production capacity, capital needs might come in terms of the human resource requirement, right. Marketing decisions influence both the numerator and denominator of return on investment. So, the numerator of return on investment is the net profit and denominator is the total amount of investment. So, basically marketing has direct impact on net profit as well as the investment amount. So, that is why it is a very crucial matrix which needs to be optimized, right. It is not an absolute metric that as you increase the marketing expenditure ROI will increase. No, it is not like that. In a way we can say that as you increase the amount of marketing expenditure, there will be some increase in let us say revenue generation, that can be fairly said, but how much, whether it is worth the marketing additional investment or not, that is not answered by. So, in this case the return on investment can actually reflect a better picture of this situation. What ROI tells the managers? So, it will address many critical aspects such as how efficiently the business uses the invested resources, right. Secondly, it can answer whether the returns are adequate relative to the expectations or not, expectations of the investors or not, right. Whatever the capital is employed by the investor, whether they are getting the expected amount of return or not. For example, if I invest something on a business, then in that case I am also taking a risk. Let us say from a government bond I can earn a return of 7%. So, it will be fair at my part to expect a revenue of minimum of 12%, because I am taking a risk in this business. In case of a government bond, it is almost a risk free avenue of investment. So, now definitely whether the business is actually able to give me 12% return or not will decide whether I am satisfied with the business or not, or my evaluation of the business says whether it is worth investing or not. The next question that it can answer, the ROI tells the manager, is that whether the assets are being employed productively or not, fine. Whatever asset you have, whether they are being employed to generate profit or not, or they are being kept idle. So, now let us quickly look at the related ROI variance. So, one of the ROI variant is return on asset, which is the most simplest form of ROI. That is, what is the net income divided by what is the total asset. So, this particular metric, as the formula says, it can be very much skewed depending on the amount of debt that the organization is taking. Fine. Then there is another metric, probably a more polished version of the return on asset, that is return on net asset. So, when it comes to return on net asset, it is similar to return on asset, but this particular refined version of the matrix takes into consideration the liability part of the business and the working capital. Fine. So, basically return on net asset is equal to net income divided by your total asset minus total liability plus the working capital. Fine. So, in a way it takes care of the liability part as well, because liability means, let us say, a debt is a important dimensions of looking into a business. Then return on capital, or in some of the places, some of the books, it is also called return on capital employed. So, basically it is a ratio between EBIT that we have discussed in previous class. EBIT means earning before interest and taxes divided by total asset minus total liability. It basically talks about the operational efficiency of the business, because when we talk about the interest, it has to be anyways paid irrespective of how you are performing in terms of the business. If you are taking a loan, it is your responsibility to return the loan irrespective of your performance in the business. Similarly, the applicable tax has to be paid irrespective of how you are performing in your business. So, that is why it just talks about the operational efficiency. Then return on invested capital. So, return on invested capital is just the another polished version of return on capital employed. So, basically the numerator in this, the denominator remains the same, but the numerator is changed, and numerator is called NOPAT, means net operating profit after taxes. Fine. So, that this particular matrix we will look into one by one. Okay. Now, let us look into the limitation of return on investment. So, return on investment as a metric often becomes meaningless in short term. The capital that is invested cannot be recovered in a year. So, that is why we have to look into it in a long term, then only we can get the actual picture of this matrix. The average over periods can hide large seasonal swings. So, we cannot directly average it, because there can be seasonal swings, there can be seasonal demand, there can be event related demand. So, that will not continue for a longer period of time. So, that is why the average over the period can be impacted by the outliers that is happening because of a season. Seasonal businesses need deeper interpretation of the quarterly and annual figures rather than, we have to go much deeper, we have to go into higher granularity in case of if the business is more of a seasonal rather than it can be a general business. Next metric that we will look into is economic profit or EVA. Basically, EVA stands for economic value added. So, first we will look into the concept of economic profit. Economic profit is profit after charging the business for the capital that it uses. Now, what we are trying to look into is that more holistic picture of the business. Rather than looking only into the profit, we are also trying to look into the cost of capital. There is a cost of capital, right? Whether you are taking a debt or whether you are generating some money in terms of shareholdings or equity, ultimately there are some expectations. If it is debt, then the expectation is the interest, the cost of capital is interest, but if it is a equity, then also there is a cost of capital. You are expected to return something to the shareholders, and it might come in the form of a dividend or in the form of some control given to the shareholders. Okay. So, cost of capital, quantitative cost of capital for equity is the dividend, but qualitative cost of capital in terms of equity is the control of the business. Now, when it comes to the economic profit, it is also called the residual income. Why it is called the residual income? Because all possible cost irrespective of operating cost, cost that is coming from the debt, cost that is coming in terms of taxes, cost that is coming in terms of capital cost, everything is taken into consideration, and now whatever value that we are getting, this is called a residual income, and this talks a lot, it gives a real picture of the business. EVA means economic value added, is a branded or popularized version of this particular measure. So, EVA is a popularized version of your economic profit. Now, let us look into how do we calculate the economic profit. Economic profit in terms of currency is equal to NOPAT minus the cost of capital. Okay? Net operating profit after taxes minus the cost of capital gives you the value of economic profit. So, in the previous matrix that we have discussed in this week till today, we have not taken into consideration the cost of capital, but whenever we are calculating a metric called economic profit, we are also taking the cost of capital into consideration, which is important aspect of evaluating the business. Now, how do I calculate the cost of capital? So, it is the total capital employed multiplied by WACC. So, WACC stands for weighted average cost of capital. Let us say, I will just give you in a simple form. Let us say one business has total capital or total asset of 1 crore rupees, and 50 lakhs is invested by the shareholders and 50 lakhs is being taken from the bank as a loan. So, if I have to calculate the cost of capital of this 1 lakh rupees, so let me first calculate the cost of capital from the debt portion, that is 50 lakhs, and let us say that debt is taken with an interest rate of 10%. So, I am saying 10% for the sake of calculation. Okay. So, for 50 lakhs, 10% of 50 lakhs is 5 lakhs rupees. So, cost of capital from the debt that is coming in a year is 5 lakhs rupees plus cost of capital from the equity. So, let us say equity is, let us say the dividend expectations from the shareholders is 8%. Okay. 8% of 50 lakhs is 4 lakhs rupees. So, total cost of capital in this particular dynamics is 5 lakhs plus 4 lakhs, that is 9 lakhs rupees. So, when and if the NOPAT is your, let us say 15 lakhs, 15 lakhs minus 9 lakhs is your total economic profit, that is 6 lakhs rupees. Now, let us look into this NOPAT as a metric. So, NOPAT is equal to net operating profit after the taxes. Fine. It reflects the operating profit after tax before financing structure effects. So, when we look into the NOPAT matrix, it tells you the entire story except the cost of capital, right. So, how you are doing in terms of what is this called your operating profit, how you are doing in terms of the taxes after applicable taxes. So, that story will be told by this metric called NOPAT. But once you also add the cost of capital to NOPAT and take the net value of that particular residual income, then probably the story of profitability is complete. In a way, what we can say is that NOPAT is the starting point of economic value added calculation or economic profit calculation. NOPAT minus cost of capital gives you the economic value that is generated for the organization, or in a way I can say, after paying for everything, what is the profit that is left on the table which is for the organization. So, where we are already minusing the cost of capital, we are already minusing the applicable taxes, we are already minusing the let us say applicable cost, let us say in terms of marketing expenditure, in terms of any other expenditure. So, what is left for the organization is called the economic value or economic profit for the organization. Now, let us try to understand the cost of capital. I have already given one example. In its traditional form, cost of capital can be divided into two forms, that is the cost of the debt and cost of the capital. Why calculating the cost of capital is important? Because sometimes in business it might apparently look like the shareholders or the founder or the owner of the business employs some amount. So, what is expected out of that amount is not taken into consideration, and that is where the actual calculation of the business fails, because the owner is also not giving the money to the business for free. He might not expect an immediate return, but at the end of the day there is some expectation, and that expectation needs to be taken into consideration before taking an investment decision, right? And hence we can say that capital is not free, whether it is coming as a loan or it is coming as an investment. You are not getting the business, means you have to look at it from the eye of the business rather than the eye of the investor. So, for the eye of the in the eye of the business, neither debt is free nor the equity is free. Ultimately everything has a cost, and the cost has to be returned by the business to the shareholders and to the bank. Firms must earn more than investor required returns. That is where the firm will generate some profit. That is where the firm will generate some economic value. That is where the firm will have some plan for expansion, organic growth. Otherwise, if there is no money left after accounting for everything, then in that case there is no, the firm cannot grow organically. So, that is where the economic profit becomes important for the firm. Weighted average cost of capital captures the weighted average cost of the funds in terms of equity cost, in terms of debt cost. Now, let us look at the fact of why economic value added is different from the return on investment that we have discussed. Return on investment is a percentage. On the other hand, economic value added is in rupee or dollar measure. This is absolute value. Return on investment is a fractional value, or it is there is a numerator, there is a denominator, but still the EVA will tell you the complete story. Return on investment might not tell you the complete story, because the EVA is already taking into consideration the cost of capital employed, the cost of the loan, the interest amount of the loan that you have to pay to the bank, irrespective of how you are performing in your business. Similarly, if you are a shareholder, you might wait for another year, but it is not free. For the business, whatever, there can be more tolerance from the shareholder as compared to the tolerance limit of the bank, but at the end of the day it needs to be taken into consideration, because it is not absolutely free. Fine. EVA captures both profitability and business size more clearly. So, in a way what we can say that out of this matrix, whether we try to compare net profit, return on asset, return on investment, or a variety of forms of returns on investment, we can just tell that EVA is a more holistic metric when it comes to the performance of the metric, performance of the business, or the long term sustainability of the business. Now, let us try to interpret the economic value added. So, if the value of economic value added is positive, which is an absolute number, then value is created for the firm. There is some money left on the table for the firm, maybe for expansion or maybe for returning it to the shareholders. If the EVA value is negative, that means ultimately the business is destroying the value of the investors, the value of the firm, and which will directly impact the return of the investors. So, what you have to do is that you have to interpret it in such a way that profit below the cost of capital means the firm has not truly earned anything. So, if the profit is above the cost of capital, that means some money is left on the table of the business, which can be used for organic growth or which can be returned to the shareholders as a return or as a bonus. Then only the value of the firm is created. Now, let us look into this inquisitive question of why marketers should care about the economic value added. Sales growth often requires more assets, more inventories and more receivables. I have already said that sales growth has direct impact on the revenue, it has direct impact on the production plant requirement, human resource requirement. It will also directly impact on the required inventories and required receivables, and that is why you need to, marketers should care about the economic value added. A better supply chain and channel coordination can reduce the capital employed. So, if you can reduce your capital employed and operate the similar level of business, in that case the cost of capital will be lesser and hence the economic profit or economic value added will be more. And ultimately, from a marketer standpoint, the EVA helps the marketer judge whether these trade-offs create or destroy the value. If EVA value is positive, value is created. If EVA value is negative, value is destroyed. And for this kind of interpretation, the marketer needs to understand this critical metric called economic profit or economic value added. Let us quickly go through this ROI versus EVA. What is ROI? Is a simple and intuitive. It tells you what is the return, what is the profit you are earning based on the investment, right. EVA is more rich for value creation logic. Basically, it takes into consideration the cost of capital, and after accounting for cost of capital, the EVA will tell you whether the value is created or value is being destroyed. ROI can look acceptable even where absolute value creation is weak. So, that is why ROI alone is not a enough explanation. ROI alone cannot tell you the entire story. So, cost of capital is an important parameter that needs to be considered, and EVA helps us looking into that dimension. Now, let us quickly compare the net profit, return on sales, ROI and EVA. Net profit equal to absolute accounting earning, as we have stated in our previous class. Return on sales, profit related to the sales, like what is the kind of, it is kind of contribution margin. Return on investment, on the other hand, it is the profit relative to the total investment, and EVA is the profit after accounting for the cost of capital, cost of debt and cost of equity. Fine. So, this is the way through which we can compare these various metrics. We must understand that these metrics cannot be used in isolation. So, each of these metrics has its own set of advantages and disadvantages when it comes to describe a particular business phenomenon, right. So, that is why it is important to have the basic understanding of each of this metric for decision making process, whether it is related to investment, whether it is related to capital structure, or it is related to some other aspect of the business. So, I will conclude this class by saying that a finance-link metric, a finance-link marketer must not only ask did we make profit, but also ask this inquisitive question, did we earn enough on the capital that we have consumed. Okay. Thank you. I hope to see you in the next class.